Good evening. Welcome to Business Day right here on ET Now. I'm Avan Dabash. Let's get in a sense as to how the markets panned out this Wednesday before we take you through the top headlines. We got off to a fairly decent start but didn't manage to hold on, and it was 40 points down from the high point of the day. 6,000 wasn't even held on to, and you had the broader markets too, which saw similar momentum. So for the Nifty, it was off by just about 0.5% at 59.71. For the Sensex, we shaved off 75 points to end close to the lowest point of the day at 19,666. Lots of big stories coming in from various sectors. All of that and more coming up after the top headlines. The government bites the bullet just ahead of the railway budget. Passenger fares go up by as much as 10%, 10 paise per kilometre, but there is no hike in cargo charges. Railway Minister Pavan Kumar Bansal says a fare hike will yield 6,600 crore rupees to the loss-making Indian Railways. Tata Motors hits an all-time high on brokerage upgrades. CLSA says new launches will give a boost to the sales, while Credit Suisse predicts stronger than expected Range Rover sales, especially in China. The stock ends the day with a gain of 4%. The slowdown in Motown is here to stay. Industry body SIAM cuts the car sales forecast yet again. The SIAM president, S. Sandilya, tells ET Now that the industry, in fact, could end the current fiscal with zero growth despite a significant jump in sales in the fourth quarter. Sebi chairman UK Sinha continues his tirade against fat cat CEOs. He says there is a need to set certain curbs on CEO salaries and also wants some companies to keep the market regulator in the loop over abrupt resignations of independent directors. Let's take it straight to our top story at 4, and the government has bitten the bullet just ahead of the railway budget. Passenger fares will go up by as much as 10 paise per kilometre, and that really had a big effect on all of the railway stocks which soared very well in the fag end of the session. The likes of Kernex Microsystems, Kalindi Rail, Hind Rectifiers, as well as the Texmaco did well in the session. But of course there was a clarification, no hike in the cargo charges. The Railway Minister, Pavan Kumar Bansal, says that the fare and the hike will yield close to 6,600 crore rupees to the loss-making Indian Railways. Let's hear him out.
Last year's plan was, of course, 44,500 crores. We wish to take it to 60,100 crores this year. The slowdown of the economy and the impact on the railways again has led down to further revision. We, after all the deliberations, careful consideration of all the issues, have decided to effect an increase in the fare hike with effect from 21st of this month.
Okay, so railway stocks really had a good going today, but the overall equity market certainly didn't. In fact, we slid off from the high point of the day, didn't manage to conquer 6,000, and it was a fairly lackluster session all in all. So that's how the Nifty and the Sensex shot sharp, off by just about 0.3%. There was massive resilience, which is what you observed for the broader markets at the start of trade, but by the end of the session, they too succumbed to the selling pressure, so off by 0.5% for the mid-cap index, with the small-cap index down 18 points. In terms of sectoral movers, it was FMCG, which from the word go was a bit of a spoil sport. Metals also added to the selling pressure. What held out very marvelously, and this too over the past many days, was the overall auto pack, so close to 0.7% higher, and oil and gas too stood out in the session. Some of the big index losers, then BHEL was rather beaten down. You had Tata Steel, which ended off by close to 2.5%. Ambuja Cements witnessed quite a bit of weakness, and ITC, which rallied very smartly yesterday, was down to end at 279.5. Some stocks in news, then you had the entire oil marketing basket, which did very well for itself in the session, as government sources indicated that oil companies may now sell diesel to bulk buyers at the market rate, which would mean that cement, mine, power companies now will need to buy diesel at the market rate, and the oil companies' diesel sales bulk to buyers may be that of 17.8% of the total. Arshia International, that one nosedived as much as 19% in trade after reports came that the company has sacked as many as 290 people, including some of the top-level executives, on Saturday, and the sacked employees allege a lot of financial irregularities. The counter was down and ended at 97. GVK Power, though, saw a good run-up, and it was largely on account of a brokerage call. You had JP Morgan, which upgraded the counter to overweight from a neutral stance, upping the target price to 19 rupees from an earlier 12. Similar scenario when it came to Havells. You had the counter which did very well. In fact, hit a new high of close to 683, ended very close to that level. Today, Bank of America maintained a buy stance, upping the target to 780. Syntex was in focus. Remember, it's going to put out its numbers tomorrow. We're expecting the top line to be up by 4.1%. Adjusted profits are seen at 80.3 crore rupees. But there was news that 50 to 60 contract workers went on strike in their Kalol plant for about a week. And the strike, though management clarified, the workers on strike were not directly employed by the management. Therefore, no impact on the operations. The stock ended lower by 1.5%. You had Elantis Beg. That counter was in focus as the company will be cutting stake in the company to 75% via an offer for sale from an earlier 89%. It will not be delisting from the Indian bourses, but we understand that the OFS will be done by the end of January. Exclusive information coming in that ICICI Securities is advising the company on the same. Bank of India soared in the session on the back of fundraising plans. It does plan to raise Tier 1 capital via preferential sale. Similar picture for a Cholamandalam investment, which is going to raise 300 crore rupees via the QIP route. Well, that's pretty much how the equity markets panned out. A bit of a disappointing session, you'd have to say. What about the F&O activity? What kind of a total turnover did we clock in? Navneet Saluja standing by from our research team with the latest. Navneet.
Well, Avan, it was a good start, but towards the last 1 hour of trade, we saw heavy profit booking coming in. That was essentially on back of higher put writing, which we saw in today's trading session. If you look at the January futures, they managed to close at that 6,000 level at about 6,001 with close to 30 points premium to the spot Nifty. And we saw a build-up of close to 4 lakh shares for the Nifty January futures. Well, if you look at the options data, the most important thing was that the Nifty PCR slipped below that level of 1 at 0.98 towards the closing. Aggressive call writing in the system was seen at strikes like 6100, which added 8.7 lakh shares. You had the 6200 strike adding over 7 lakh shares, whereas in the put side, couple of strikes witnessed profit booking. That was open interest was seen shedding there, and only addition was seen at 5900 put strike, which added 2.4 lakh shares. And talking about the stock futures, among the Nifty gainers, you had Tata Motors, which rose in today's trading session after the upgrade which came from CLSA. You also had long positions being built up for stocks like GAIL and Coal India, which were up in today's trading session. On the short side, you had Tata Steel and couple of cement counters like Ambuja and Ultratech, where short positions were seen in today's trading session. And couple of auto stocks, Hero Motorcorp, Bajaj Auto were down in today's trading session. And talking about the mid-cap space, Bhushan Steel was down, whereas long unwinding was seen in Renuka, which was in the ban period today. And Suzlon, GVK Power and Havells, these three counters, they did well. Long positions were being built up. And talking about the participation, well, no surprises. The turnover is just about average. On NSE, we did about over 1 lakh crore by the end of the day.
Thanks very much, Navneet, for giving us all of the latest details in the F&O space. But more importantly, today, the earnings season kicked off with IndusInd Bank putting out its numbers. Here are the profits, which were boosted by strong net interest income, which was higher by 34% to 430 crore rupees. That means the overall profit went up nearly 30% to come in at 267 crores in the third quarter. Asset quality was maintained. You have the gross NPAs coming in at 0.9% vis-a-vis 1.03% on a quarterly basis. Meanwhile, the net NPAs stood at 0.3% versus 0.2% on a quarter-on-quarter basis. Let's hear out Ramesh Sopti talking more about the bank.
We are now on a NIM at 3.45. I think that was one of the biggest features of this quarter, and that's why we've shown a net interest income growth of 34%. Our gross and net NPAs gross NPAs have actually fallen by 2 basis points from 1.01 to 0.99, and this is after absorbing the impact of a large bad debt in the industry. As you know, Deccan Chronicle hit almost every bank. We have absorbed the impact of that and yet shown a net profit growth of 30%.
Well, the stock price managed to end in the green on the back of those numbers. Meantime, Tata Motors was in focus as it hit an all-time high after two brokerages upgraded the stock. CLSA started off by saying that it was an optimistic of the Tata Motors new launches, while Credit Suisse expects stronger than expected Range Rover sales, especially in China. Let's take it straight to Yatin Mota, who joins in from our research team with all of the latest details on the recent upgrades. Yatin.
Well, it's not only Tata Motors, but it's also the auto index, which has been trading at record high since the last 3 or 4 trading sessions. Talking specifically about Tata Motors, and the upgrade cycle for the stock has begun. Last week we had Bank of America Merrill Lynch, which upgraded the stock, and today morning we had Credit Suisse as well as CLSA, which have upgraded the stock. Target price been up by both of these brokerage anywhere between 30 to 50%. Talking about CLSA, and they have a price target of 385 from the earlier level of 300. Credit Suisse, on the other hand, has a target price of 390 on Tata Motors from 226 earlier. And the clear focus has been JLR, because most of the brokerages feel that the Chinese market, which have been growing by nearly 40% for Tata Motors, will outperform. The uncertainty in the luxury car market is now, slightly getting diluted day by day, and that is why they believe that the luxury car market's volume will recover and bounce back in the Chinese market, which is a positive for JLR. Also, the new launches which JLR is planning, which is the new Range Rover Sport, as well as the new Jaguar variants, will help JLR boost volumes in the coming months. And that is the precise reason why, CLSA has also upped the EPS target for the company by 5 to 8% in the next 2 financial years. And most of the brokerages have put a growth figure of nearly 20 to 25% in terms of earnings growth for the next 2 or 3 years. So healthy earnings coming on the back of strong JLR volumes, especially from the Chinese region. And also the new launches possibly will help, Tata Motors gain momentum on the earnings front going forward.
Thanks many, Yatin, for joining in with those details. But not very good news for the overall auto industry, given that the slowdown in Motown, we understand, is here to stay. The industry body SIAM has cut the car sales forecast for the current year yet again. The president of SIAM, S. Sandilya, spoke exclusively to ET Now, saying that the industry could end this current fiscal with a zero growth, despite a significant jump in the sales in the fourth quarter.
Forecast is based certain variables that we have seen in actual as they plan out, and also what we expect that the impact will be in the next quarter. So based on that, we take the total year's forecast, and therefore, as indicated by the last 3 quarters trend, we do believe that the next quarter is not likely to have any significant increase, because there is no new development that has taken place either in terms of interest cost reduction or fuel prices coming down or increase in infrastructure spending. Therefore, we don't believe that there could be any positive sentiment in terms of the quarter sales going up in the fourth quarter, and therefore the year's forecast has been brought down. It is not indicative that what will happen in the next year, because that is something which depends on the kind of actions the government takes in the next quarter.
So there are talks of diesel prices going up now. How do you respond to that? Do you think it will be, impacting the industry in any way?
As SIAM has maintained always, the diesel prices should also be deregulated, and the subsidy being doled out today is not warranted. Except that if you want to give subsidy to the real poor farmers, which is the intention of the government, they can do it through the direct credit route, which is in terms of Aadhaar scheme the government is talking about, and whereas the overall general prices for the market should be market-led. Now, once that happens, then I think the gap between the petrol and the diesel prices will come down, and that augurs well for the economy. And we have always maintained that it must be deregulated, and therefore any step that the government takes in terms of deregulating the diesel prices, making it market-led, whether in terms of 1 rupee per month increase or 10 rupees increase at one point of time, whatever step the government takes, we will welcome it from SIAM perspective.
A move that will perhaps clear the decks for the government to sell its residual stake in Hindustan Zinc. The Finance Ministry has now asked the Law Ministry to reconsider its previous opinion that had barred any stake sale in the company. Let's get in our policy editor Supriya Srine from New Delhi. Supriya, what has made the Finance Ministry go back to the Law Ministry, and why is the government keen to sell stake?
The government realizes there's big money at stake there, and that can be a huge revenue stream, about 21,000 odd crore of money that can actually come in from the stake sale, residual stake sale, both in Hindustan Zinc and Balco. The litigation really has always been on Hindustan Zinc, but now with the Supreme Court judgment that had really quashed a PIL which had challenged the Hindustan Zinc stake sale, the government is certain that the stage has been set, and which is why it has now asked the Law Ministry to reconsider its earlier opinion that had barred any stake sale in Hindustan Zinc Limited. The government believes that a Supreme Court judgment, and typically, yes, it does hold more value, and which is why perhaps there is a need to review its earlier opinion. Important to remember here that the stake sale in Hindustan Zinc had happened between 2001 to 2003. That matter was under litigation. It happened for the very first time under the NDA regime. Both parties are still in the Delhi High Court, and which is why a residual stake sale was being opposed to by the Law Ministry. But informed sources say that Finance Minister Chidambaram is extremely keen on getting that money on the table, because other revenue stream like a spectrum auction sale has dipped considerably, and which is why he wants that money to come in this fiscal itself. And perhaps we are a step closer to a residual stake sale happening both in Hindustan Zinc and Balco. Remember, Balco has no litigation. The litigation is only on when Hindustan Zinc, so to say.
Supriya, thanks very much for joining in and filling us in with those exclusive details. Meantime, days after releasing the consultation paper which proposed path-breaking reforms on corporate governance for India Inc., Sebi Chairman UK Sinha today slammed the trend of high CEO salaries and sudden resignations by independent directors. Let's get in Ashwin Mohan, who now joins in for more details on this. Ashwin, fill us in on Sebi's stance regarding the same, because some very important comments did come about today.
That's right, Avan. In fact, Mr. UK Sinha's statements are extremely important because they are the first official statement coming in from the chairman of the Securities and Exchange Board of India after that recently released consultation paper which sought to improve corporate governance norms in India. Those are the two buzzing topics, and those are the two topics that Mr. Sinha was referring to: high CEO salaries as far as certain Indian companies are concerned, and also independent directors mysteriously disappearing from the boards of listed companies. Clearly, market watchdog Sebi's outlook is that in certain cases there are certain CEOs whose compensations are unnaturally high if you compare them to certain foreign counterparts, and clearly UK Sinha wants to keep a check on them. He's made it very clear that he does not want to dictate what the salary should be, but clearly the message that he's sending out is that in the coming days, along with the Companies Bill also soon going to become the law of the land, they are looking at a policy which would have a set of parameters which would dictate this controversial subject as far as high CEO salaries are concerned. Moving on to independent directors, Mr. Sinha did not mince any words, because he clearly pointed out that there are several instances in corporate India where independent directors have resigned without giving any reasons. Therefore, he's talking about greater disclosures. So the key takeaways from both these statements are minority shareholders should not be kept in the dark as far as the reasons behind independent directors resigning are concerned. And of course, as far as CEO salaries are concerned, they should be aligned with the goals and performances of the company. So there you have it, market watchdog Sebi stepping into two certain buzzing areas as far as corporate India is concerned.
Coming to the question of executive compensation, the idea is that the short-term interest of the executives, senior executives, should not guide the company into taking unnecessary risk. If you look at the global developments in the last 5 years, in many of the large companies, that was precisely the problem, that they were allowed to take very, very short-term risk because that was going to affect their compensation. So we want to send some parameter. We don't want to decide the salary. We want to send some parameters. And I would like to assure you that whatever Sebi does, it will be done not in a disruptive manner, which means we will implement it in stages.
Meantime, to an important voice in the legal arena and in a freewheeling chat with ET Now, the undisputed queen of Indian M&A and Tata Group advisor Zia Modi says age is the biggest strength of Cyrus Mistry, who will continue the trend of big-ticket deals set by Ratan Tata and continue to press the pedal on gobbling up strategic assets. Modi also hopes that market watchdog Sebi will pull up its socks when it comes to tackling insider trading.
I think his age is his strength, actually, not his challenge. I think the challenge is, as Mr. Tata's farewell letter, which was publicized, says, just the world next year. It's going to be a tough, tough world. Mr. Mistry is going to have to battle and navigate his way through things which are essentially beyond his control. But, you know, there's a year after that and a year after that, and he has many miles to go. So I don't think we can really base it on the immediate future.
Do you expect a Tata as acquisitive as it was during the Ratan Tata era?
Most likely. I mean, hasn't Cyrus made a statement that he's going to pump in 45,000 crores in Indian and overseas investments? So I don't think he's going to slow down, but I think, as always, there will be calibrated, rational decisions that you would expect a group of their size to make.
If there is one area that you could pinpoint when it comes to insider trading norms in India, wherein we need to pull up our socks, what would that one pointed area be?
Proper surveillance software by Sebi. I think the main lesson is quick enforcement. I mean, we are constantly reading about, trying to basically capture in the hedge fund space, if you like, all people who have traded on inside information. Why are we getting verdicts in a year? In India, we would not get verdicts in a year. So I think that when people read about it, again, what is America doing? It's disseminating it. It's making people aware of it. If you do this, you could go to jail. Do you want to go to jail? Do you want to lose your mansion? Do you want to lose your yacht? So be careful. So I think that's what is not happening here.
Interesting perspective as always from Zia Modi. The Oil Ministry is very close to finalizing the draft policy for shale gas exploration in India. And in a move that will benefit companies like RIL, ONGC and Ken amongst others to participate, the ministry may allow existing operators to participate directly in their own geographical area of exploration. Nithya Balakrishnan now joins in with the exclusive details. Nithya, take us through the broad contours that the Oil Ministry is proposing in its draft and how soon will it be ready?
Well, expediting shale gas exploration seems to be top of the agenda when it comes to the Oil Ministry, and sources indicating to ET now that very clearly going ahead, they are looking at the legal possibility of permitting existing contractors to actually mull the possibility of shale gas exploration in their own blocks. We're given to understand that they are examining the legal options of this simply because the Oil Ministry feels that letting one company continue in its block with shale gas exploration is better than opening it up for bidding, asking for fresh contractors and new developers for that particular block, as it could result in conflict or even arbitration at a later stage, something that the Oil Ministry is very keen to avoid. They're saying domestic production hike is all that's important, and going ahead they're looking at whether existing operators should be allowed to explore shale gas in their fields. We're also given to understand it will be a production-linked payment model that Oil Ministry is very keen on, because it does see merit in Rangarajan Committee's recommendations as well. However, on the Environment Ministry front, a little bit of hurdles that they're facing at the moment. There has been no response from MOEF when it comes to the draft shale gas policy. They've invited comments to the Oil Ministry. They've also indicated MOEF should be traveling with them to assess the kind of exploration and the impact it's had in the United States, where shale gas exploration is flourishing. But MOEF has not responded. Very clearly what we're picking up from Oil Ministry sources is that they're not going to wait anymore. In the next 10 days, they will be finalizing the draft cabinet note when it comes to shale gas exploration. And we're picking up from our sources that by January 30th, they're very keen on implementing this policy going ahead.
Thanks very much, Nithya, for pointing out all of those exclusive details. To the pharmaceutical space, and in yet another twist to the FDI and pharma policy, the Law Ministry has now said that the competition regulator cannot have powers to cap production after an M&A transaction. This was approved by the cabinet, and why is the objection and what exactly this means for pharma M&As? Let's get in Devduta Das. She now joins in with the exclusive details. Devduta.
It definitely is a twist in the tail now, the fact that the Law Ministry has given its opinion. It says that to give the CCI powers of capping production for sectors is going to be too much power in the hands of the CCI. It believes, the Law Ministry has said so, that it believes that this kind of power in the hands of the CCI will lead to hurdles not only for other sectoral regulators but also for policy making in the future for ministries under which these particular companies or these particular industries fall, for which they make policies. Also the fact that if these kind of powers are given to the CCI, the competition regulator will ultimately end up overstepping its domain of looking into only monopoly or M&A related issues. It will be going into policy making and tweaking of policy, which is really not its domain. So this does diminish the chances of the competition regulator being able to vet any pharma M&As, but then again the real call lies with the cabinet, which is where the entire decision will go back once this opinion is taken.
Thanks very much. We await those details, Devduta. But with that, we're completely timed out right here on Business Day. Thanks so much for watching. Keep it with ET Now.